So there's an interesting term which I have noticed in YieldWiseX platform also. You have used the word new reality. Could you tell our viewers what is new reality and how do you define this? Like,
Sure. So, a lot of people, when we started off our platform, they had various engagements with real estate investing, albeit via brokers or, maybe buying an apartment from a developer. But these are all traditional methods of investing, and we were doing something different.
yeah.
So, to reinforce that vision, we started this word called neo realty, saying that this is the new age way of investing, new approach of investing. The things that we are offering are not traditional. We are doing it through a differentiated perspective, and that was really the whole intent behind neo realty.
Nice. So, coming to the recent announcement that was done by Finance Minister Nirmala Sitharaman, she had announced that all the direct listing, equity direct shares will be listed in the IFSC, where it gained a good development from the Indian companies also. Now, Indian companies have an option to direct list in foreign exchange through GIFT IFSC. What's your take when it comes to such announcement? How does it impact the overall commercial real estate?
Sure. So, when a country opens itself up to foreign capital, and I think India has done so gradually, but very conservatively, you would have only seen foreign money through funds like Brookfield, Blackstone also pour in the more recent times, right? Maybe 10 years ago, these names were not as prominent as they are today.
Yeah.
So, India has taken a lot more of a conservative outlook in terms of enabling foreign capital, enabling companies to go abroad, which has allowed us to be quite stable, right? So today we're not very dependent on, like, right now US is debatably going through a recession, but that's not having the same impact on us as it is on other countries.
True.
So foreign money is good. Access to foreign money is good. It enables the whole country and ecosystem to grow. Real estate is the core underlying asset, right? So let's assume IT sector grows. IT sector, the number one thing is IT parks. IT parks are real estate.
Yeah.
So at the back end of growth, you'll always find real estate. So, participating in real estate is like participating in the Indian growth story on a more fundamental level. So I do feel that, the headwinds of India, the favorable demographics, the sort of perspective taken by SEBI, the forward-looking policies that are coming in, all of these things are going to take India to a very, very different level, which in turn will take real estate to, very progressive level.
True. And as you mentioned earlier about HNIs, do you feel the current, the global politics or the economy which affects right now is affecting the US, China, even UK? Does it affect your investors' portfolio through people who are investing from outside when such, news is happening? Does it affect your portfolio of investors when it comes to fractional ownership?
Sure. So actually, this is the beauty of alternative investments. So equities are more susceptible to market volatility.
Yeah.
When a global event happens, the markets go up or down. Real estate doesn't move like that, at least not A-grade real estate. So even when COVID happened, right, your B-grade, C-grade buildings got vacated. Your A-grade buildings didn't get vacated. I mean, in fact, the price went higher because people understood and appreciated the importance of quality, the importance of, the workplace environment. So usually these alternative investment products are not closely correlated to market. So even though you go through volatility, people use these kinds of products as hedges against these kinds of downturns. So even in the pandemic, you would have seen a huge upswing in people investing in gold, in real estate, because these are the hedges against market volatility.
True. So also tell me, when it comes to the current market in Indian real estate finance investment, what we have noticed, there influx of AIF companies coming, fractional ownership is there. We are also noticing like recent company like HBITS got regularized by SEBI, getting AIF category 2 fund to raise for commercial properties, where we haven't seen any players getting into it apart from Resi AIF players. Where do you see AurumWiseX heading into this particular space?
Sure. So, as a larger vision, as a longer term goal, we want to be able to offer investors various kinds of frameworks via which they can participate in real estate. So, we started off with Fractional, which is still one of our core offerings. We supplemented that with debt, which is again one of our now established verticals. Next month, we are launching a PMS. Next, we have an AIF license, but we are probably going to launch that, early next year. So the idea really is that, one size doesn't fit all. Each has their own preferences towards risk and returns, towards the liquidity, towards the amount of time horizon they want to invest for. So we are making all these different kinds of frameworks accessible, and we are doing it all from a very curated perspective. So on our platform, you'll never find a third-party product. Everything that we offer, we originate ourselves, so we can control the risk associated to each offering.
So we would be seeing you guys getting into AIF as well?
Absolutely. So we are very keen. We are in fact, so once the PMS that we launch stabilizes over the next 4 to 5 months, post that we'll launch, our AIF.
So is it like a strategic, call that under one umbrella, you want to provide different kind of investments to your investors, the different portfolios? Is this like a strategic vision that you guys see for the company?
I'll put it another way. We've developed very good expertise in real estate and credit. And basically, we want to scale that up into all these variety of products, right? So there's the AIF real estate industry. There's the PMS industry. Now we want to enter that from a real estate perspective. So yes, in terms of having all of this, we definitely do want to have all of this. And I think because of the kind of expertise that we've built, it will be easy for us to supplement each vertical with the next.
And would you be focusing only on commercial, or you be also heading into residential properties?
So right now only commercial. We have a strong core competency in commercial, and we want to stick to that. So we'll start with commercial. We're a little bit of a conservative platform, and we'll see where we go from there.
So as we've seen so many reports recently coming in and showing, and it has compared with the residential, office commercial space give you good rental yields, right? So what is your take with the 2023 and the next year? What current trends we can see in commercial real estate, and what other evolution of finance investment we can see in real estate?
Sure, absolutely. So, India is the ITS hub globally.
Yeah.
So a lot of your outsourcing comes to India, albeit from your consulting companies, your large tech companies. A lot of their main outsourcing facilities are set up in India. Now, why does this happen? So there are three fundamental reasons. One, you have $1 per square foot ballpark rentals in a lot of these IT parks, which is very favorable when you compare it to, let's say, rentals which are maybe 4-5x in the US. The second thing is we have a lot of talent and very affordable talent. So, when you look at the difference in wages in absolute terms between us and these countries that are outsourcing to us, it's drastic. So, it makes it very, very economical. The third reason is we have very favorable demographics. Right now, 50% of our population is below the age of 25. Yeah. So when all of these workforce are entering when all these individuals are entering the workforce, it allows for a ecosystem of IT or industry like IT to thrive. So, that's one of the main macroeconomic factors that has driven real estate or commercial real estate even in the past few years. Like if you see what is office space in commercial real estate fundamentally, the maximum stock is in IT parks.
Yeah.
The lowest vacancy is in IT parks, and that's because of these, reasons. So that's one of the major things. The second major thing is that India is coming out to be one of the most favorite economies globally, and that's because of the China aspect. Them not having such good global reputation anymore. It's companies are backing out of China today. A lot of European countries have weaker economies, or sort of spiraling economies. UK is going through a crisis. US is going through a recession. So fundamentally, India has a very, very strong, headwind. Our growth is continuing. Our companies, not only in real estate, but overall as a country, are showing sustained growth. So, in a macroeconomic condition such as this, I feel India is poised for, very, very good growth trajectory. I mean, often I say, these are the next 10 years for India. This is where we're going to see maximum growth, maximum development happen in the country.
True. So let's talk about the challenges of this market, because, of course, the SEBI has got on good regulations to make sure no discrepancies happen, be in any finance investment companies, be AIF or be fractional ownership. But when it comes to entry barrier, right? AIF minimize starting is 1 crore, and fractional companies as yours, every company start with all the portfolios from 15 to 20 lakhs. My question to you is, when it comes to so many companies getting involved in this particular space, there can be problems, and of course, it's a hypothetical situation. There can be problems where the company can even take the portfolio and give out, right? And it can affect the market sentiment, it can affect the investor sentiment. So, what do you think the barrier of the entry or the entry threshold should be increased by the government, or there can be more scrutiny by the government? What is your take?
Sure. So, this question I can answer a lot better today, having dealt with regulations a little bit more in the last few months, especially in the fractional space. What I've seen at least, so I'll first talk about the fractional regulation, because what I've seen from SEBI's approach is that they're not trying to ban an innovative framework. They're not trying to be, very, very conservative. They're actually trying to promote frameworks which have a strong value proposition for investors, while ensuring that the retail investor, he's getting all the information. He's not being basically led down let's say a scheme or a bad investment or things like that.
True.
Now, how do you avoid bad actors in the industry? I mean, like you're saying, there might be a platform that comes up who doesn't follow all the instructions. So that's really where SEBI comes in. Like, at least in the fractional ownership regulations, they're requiring us to have a certain amount of capital on our balance sheet. Now, why are they doing this? Because they assume that someone who can arrange this amount of capital and keep it liquid on their balance sheet is serious enough, right? They have enough skin in the game.
Yeah.
They're forcing us to invest 15% into every property. Now, again, why are they doing this? They're doing this to ensure that we have enough skin in the game, that, what we are recommending to someone, we are also confident enough that we're investing into. So a lot of SEBI's regulation is aligned to ensure that what we are doing is in the best of intent for the investor. Now, investments can go either way, but the idea really is that we shouldn't be mis-selling. No platform should be mis-selling. There shouldn't be bad actors, and that's really what compliance really helps ensure. So once you get compliance in, once you get regulation in, it allows the industry to mature. I mean, just giving a parallel to this, see where the mutual fund industry was 15 years ago.
Yeah.
Right? There were a ton of bad actors. A lot of things went south.
Yeah.
SEBI over time iterated. They made the framework more sophisticated. Today, look at mutual funds. I mean, I think everyone has some level of exposure, right?
True.
So a lot of confidence builds in the asset class. It becomes mainstream. So whilst when SEBI comes up with regulation, the best way to describe it is short-term pain for long-term gain. So it is short-term pain for platforms like us. We have to adapt. There are a lot of criteria we have to fulfill. But in the longer term, I mean, the kind of gain that you realize by ensuring all these things are in place is really unprecedented.
So too much information, as you said, is always there, but can be also a harm. For example, like how you quoted, like maximum population in our India is below 25 years, right? There are a lot of fintech influencers. There are a lot of influencers around who are telling you what to invest, where to invest. And when it comes to the debate of, REIT versus fractional ownership, they are mixed. Where I even go through YouTube and other influencer recommendations to the youngsters, some are suggesting REIT is a good option because it gives you immediate returns, like how you invest in a stock. But when it comes to fractional ownership, and of course, person who is below 25 won't have right away 15-20 lakhs to invest. For him or her, the option REIT sounds quite interesting. So what's your take when it comes to such debate, REIT versus fractional ownership?
So, what I truly believe is that not only in this debate, but any narrative associated to guiding someone's investment choice has to be regulated or has to come under certain frameworks of checks and balances, right? So we are seeing this, like you correctly said, in the influencer space. There's a lot of scrutiny of that segment, fundamentally because of them. And I'm not going to say all of them. Obviously, there are good ones and bad ones. But one of the major taints of the industry is that they're selling what is in their best interest, right? So the ones with higher margin products or the companies in which some of them have stake, now promoting that is not doing it in the best of intent. So usually now SEBI is even stepping in here.
Yeah.
Right now they're putting in certain checks and balances on these kinds of influencers. So you can't sort of pick up one part of the whole process and try to regulate it until end to end. You don't have a system, you don't have certain guidelines. It's difficult. It's difficult for it to become mainstream. So whilst influencers are important, they raise awareness. Whilst a lot of these content channels are pertinent to raising awareness and building a category, it has to be done in a controlled way.
So what's your take when our viewers want to be informed and educated when there's a comparison between REIT and fractional ownership?
Sure. So, the fundamental difference would be like picking a stock versus investing in a mutual fund.
Yeah.
Now, what happens in a mutual fund? Whilst in mutual funds, you do know the underlying property equities, but you don't necessarily pick them yourself, right? You're just investing into a pool, into general sentiment of the equity market. Now, similar with REITs, like you're investing into the general sentiment of the real estate market. Mutual funds will have a lower return against a stock which is going up well. Now, why do you pick these superstar, stock pickers? Like, I mean, lack of a better example, Rakesh Jhunjhunwala. The reason is he's able to identify those stocks, the ones which give you multi-bagger returns, as opposed to mutual funds, which will give you sustained growth, but they'll give you a lower growth. So similarly, in a REIT, you will get growth, but in fractional ownership, you're picking that one asset. You're picking an asset in which you're getting opportunistic entry at a lucrative price. So experts or platforms like us identify those opportunities and enable investors to participate. So that's the fundamental difference. Both are means of accessing real estate. One is a more concentrated, opportunistic, return-oriented product. The other is more of a long-term, like a REIT is more of a long-term investment, slightly lower returns, depending on how the other does. But this is the fundamental difference.
And what are like the exit formalities? Because in REIT, if I put in the stock, I can immediately even take that money out also from the market. When it comes to fractional ownership, even for our viewers to understand, if they're investing, is it like a 1 year lock-in, or do they have to wait to see how the market is going and then exit, or can they do the early exit and it might affect their returns?
Sure. So, I'll talk about our platform because I'm not certain about the others, but we offer a very active secondary market which enables investors to any point in time exit their fractional shareholding. So the full property gets exited down the line at an optimal exit value, but in the interim, let's say if someone has a pressing need of funds, they can reach out to our team and we list it on our secondary market. Now, just purely based on data, we've had about 27 exits in the last 2 quarters. The average time to identify liquidity and find the replacement buyer has been under a week. So, whilst this is not an indication of future liquidity, but in the past it's been quite liquid, and the reason to that is actually good asset selection. None of our properties are vacant, all of them are yielding, rentals are intact. So, there's a lot of confidence in these properties. Now, of course, if a property gets vacated, there's no rental income for some time, the property has been bought at a high price, then yes, secondary exits will be a challenge. But in terms of liquidity, we are trying to achieve the liquidity of a listed REIT, and under SEBI's new regulation, we probably will be able to. So that's also another form of a REIT. But in the old avatar, I would make a closer parallel to, let's say, owning your own commercial real estate asset.
Yeah.
Right? It's like owning your own office versus this. So this has a much more favorable liquidity structure. But in terms of the overall nuances, it's more akin to owning your own asset.
So what kind of properties do you have the portfolio of? Like grade A properties even have office, warehouse, data centers. What kind of properties are you guys holding in your portfolio?
So currently primarily office space, and the reason to that is because leasing is very long term. So, MNCs sign 10-year, 15-year contracts. We try to pick up only new assets, so assets that are constructed maybe within the last 3 years. The reason to that is, as a building ages, the ability to realize appreciation starts to become lesser and lesser. Now, of course, there are outliers like a Mega Max City.
Yeah.
But in general scheme of things, the newer building will show higher appreciation as a very broad rule. So we fundamentally stuck to office space, again in very, very core micro markets, A grade. So we have like in Mumbai, next to the airport. In Bangalore, we have an ORR. In Pune, we had in Hadapsar. So these are very, very mature micro markets in which leasing is not a challenge, in which there's demonstrated track record of tenancy, of leasability, of established market rentals. And even through the pandemic, not a single one of our tenants asked for a discount. None of them vacated. In fact, if they vacate today, I'll probably be able to achieve a higher rental. And this happens by good asset selection.
True. And what are the current cities where you guys are active in?
So we wanted to focus on tier 1 because, in volatile times like COVID, the more mature the market is, the less volatility you're going to see. Like in ORR in Bangalore, there was almost no tenant that vacated. And even if they did, almost instant replacements did happen. Whereas if I take a market like, let's say, Jaipur, there were vacancies there and they're continuing. So that's why we wanted to be very conservative. We picked up only in key A-grade mature micro markets. And going forward, I think we're going to continue to stick to that strategy because, another important thing to understand is your target segment, right? So someone investing 25 lakh rupees, he wants his yield, he wants some appreciation. He's not looking for a 20-30%, but he wants stable income, right? So we don't like taking unnecessary risk, when sort of making these kinds of investments. Like if a HNI is putting in 30 crores, he's aware, he's knowledgeable of the risk he's taking, then yes, he can go and take a project in a T3 city, and he might realize a 4x return in a short period, but he also might realize a downturn. True. So you have to match the kind of risk that you're onboarding with the investor mindset that you're catering to.
And do you guys also have a certain criteria when you're selecting investors for your portfolio, or is it open, like whoever comes in and first come first basis, or is there particular filtration from your end also to, of course, there are few investors who might put like, yeah, we are ready to put 25-30 lakhs. But do you guys also take the call ki, let's not give this portfolio to him? Do you have a certain checklist for the investors?
So we don't discriminate based on any basis other than, for lack of a better word, a criminal track record. So we have a platform which is called Karza. So they're a third-party platform. We run our KYC and identification checks via them. It's an instant API-driven solution. Really cool, honestly, if you ask me. And they give us insights. So far, only one potential investor, we couldn't accept investments from. But other than that, no such.
Because of the criminal background.
Yes.
Okay.